Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 25th of May. I'm Daniel Lam, your host for the podcast. The moves in US 10-year Treasury yield have big implications on fixed income and duration trades. Now, this had pulled back from 4.25% in October last year to 3.25% in April this year. Over these 2 months, however, the US 10-year Treasury yield had retraced 50% of the range and went back up to 3.73%. This was a result of tug-of-war between those advocating for a pivot due to the impending recession and the still better than expected economic data in the US, signaling that growth may not be slowing down as fast as many would have been expecting. All these make reading into the recent Fed narratives extra interesting. In a nutshell, despite a few Fed policymakers having recently advocated for a higher funds rate, a broad survey of all recent Fed commentary and the minutes from the May FOMC meeting suggests that the Fed is more likely to be keeping rates on hold when it meets in June. So during the past week, Fed Governor Waller and regional presidents such as Bullard were hawkish on further tightening. But on the other hand, Fed Chair Powell, Governor Jefferson, and some other regional presidents like Barkin were a little bit more circumspect. So the distribution of those speakers largely lines up with the dot plot from the March FOMC meeting, which shows that 7 participants were in favor of hiking above the current 5% to 5.25% target range, but 10 of them prefer to keep rates stable. Now, taking a look at the May FOMC meeting minutes that came out overnight, the dot plot did not appear to have changed significantly since March. So the minutes show that many participants were focused upon retaining optionality in the policy stance, while only some thought that additional policy firming would be needed at future meetings. So the bottom line is that there seems to be more support for a pause at the June FOMC meeting versus another hike. While further rate increases are possible later this year, we only see them occurring if core inflation starts to inflect higher, which is not our base case here. Actually, we continue to believe that the Fed would start to cut rates in the second half of this year. So putting 2 and 2 together, combining this with potential volatility that may arise from the ongoing debt ceiling debate, this suggests that US 10-year yield may see downward pressure soon. So this bodes well for investors to add to high-quality bonds as well as gold, which we've been discussing in the podcast this week. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and I wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.